Okay, you can have one good trade idea after another, but if you don't know how to get a great entry or exit, you will always struggle. In this video, our head of trader development teaches you the top 5 candlestick patterns to get great entries and great exits. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and now Miami as well, and proud to develop numerous great traders. Watch, take notes, and learn from the team at our prop firm so you can grow your trading account.
Boom, that right there. That's what you're missing. One simple candlestick pattern just gave traders a massive edge, while everyone else was just sitting around clueless. Okay, so here's the deal. If you're not using candlestick patterns the right way, you're trading blind. And I don't care how smart you think you are. If you can't read price action, the market's gonna rip your face off. So today, I'm gonna give you the 5 most powerful candlestick patterns that you need to master if you wanna trade like a pro. No fluff, no theory, just real strategies that can instantly improve your trading. And I'll show you how to use the SMB Scalp Radar to catch these setups automatically. Because let's be real, the best traders aren't wasting time hunting for setups. They're actually reacting when the moment's right. Candlesticks are the closest thing we have to a market lie detector test. They actually expose the truth behind the price action. Who's really in control, the buyers or the sellers? So most traders, they wait for some lagging indicator to confirm what price already told them like 10 minutes ago. But today, you're going to learn how to read price action in real time. All right, let's get right into it. The top 5 candlestick patterns every trader must master. And I promise you, by the time we're done, you're never going to look at the charts the same way again. Number 5 is the engulfing candle. It's the power shift pattern. So what's actually happening is the engulfing candle is a 2-candle reversal pattern that shows this sudden power shift between buyers and sellers. A bullish engulfing pattern is the market's in this downtrend. Sellers are confident. They're pushing prices lower. Suddenly, this huge green candle completely engulfs the previous red candle. Buyers have overwhelmed the sellers. They flipped that trend back upwards. The inverse happens on a bearish engulfing. So the market's in an uptrend. Buyers are in control until a large, distinct red candle engulfs the prior green candle. Sellers just completely overpowered the buyers. This is a clear momentum shift. It tells you that the previous trend is done and a new trend is starting right now. The best way to trade it is you just wait for confirmation. The next candle should close in the direction of the engulfing candle. You heard that right. The very next candle should trade in the direction of the engulfing candle. You enter after that confirmation, setting a stop below the engulfing candle's low for a long or high for a short. A really common mistake we see traders make in this is they start jumping in too early without waiting for confirmation. Fakeouts do happen. The price action looks like it's going. You see that bearish engulfing or bullish engulfing candle, but then the fakeouts happen. You have to watch this very carefully and allow that next candle to develop. You have to see the high of that candle get taken out if you're just trading this candlestick. So imagine this stock has been declining for days or even hours, let's say. Everyone's selling. It's like you cannot get a bid to stick higher. Suddenly, a huge buyer steps in and they create this bullish engulfing candle. That's your green light because finally that bid is stepping higher. It stepped above that candle, and then we look for that bid to remain there and continue that upward momentum. That shows us that big money is coming in. On the SMB Scalp Radar, we look for these over and over using rubber band trades. So we look for that engulfing candle to really signal that change. The SMB Scalp Radar sets you in the right position so you can just focus on the execution. But again, what we're looking for that bullish engulfing is not just that candle that takes out that prior candle to the downside or to the upside, but then we're looking to see that continuation. That's the key here. We can have these bullish engulfing candles in the middle of a range that don't mean anything. Bearish engulfing candles in the middle of a range that don't mean anything. But when they come at the right time with the right context, they can mean everything. Number 4, the doji. This is the storm is coming pattern. And what's happening here is a doji forms when the open and close prices are pretty much the same. Neither buyers nor sellers actually won the battle that was occurring in that candle. The market's pretty indecisive. The people trading the stock really don't know yet. It tried going up and it tried going down, but ultimately it closed kind of right where it started. It's a real tug of war where both sides pulled hard, but no one moved. It's almost like no one blinked. The doji is kind of a warning sign because it doesn't mean buy or sell on its own, but it tells you often, and it can signal, especially with a decrease in volume during that doji, that a big move is potentially coming. So you want to, again, look at what's going to happen next. If the price breaks up after that doji candle, especially on high volume, after we had that low volume moment of indecision, that low volume battle between the buyers and sellers, if you get a high volume break higher, go long. If it breaks to the downside, go short. One of the best things you can do is look for a doji, that battle to occur at a support or resistance level. Ideally, what you're looking for is that doji, that battle to occur when price is above a resistance level, and then you get that continuation long, or below a support level, and then you get that continuation short. A common mistake that a lot of traders make when looking at this pattern in isolation is they're thinking the doji automatically means a reversal. It doesn't. The key is actually waiting for that confirmation. Sometimes it can really mean continuation. There can be this temporary battle and then you just see continuation. You want to look for what happens next. It does not always signify a reversal. Sometimes it can just be a pause in a much bigger trend. A real live example of this is you see a stock trending higher and then it breaks above the highs of a resistance level. It puts in this base and then that doji appears. The next candle looks like maybe it's going to go lower, but then immediately explodes higher. That candle pattern allows you to put yourself in the right position. We're above that resistance level. Then you had that momentary pause where maybe some people are a little concerned. There was a little battle that occurred. And then you see that buyer kick back on. That doji was that pause. It was a little bit of a warning sign that it could go either way. But then when you get that break higher, that's that really good opportunity to capitalize on. Now, a quick note about all of these. All of these patterns, all of these candlesticks matter so much when you look at the volume component to it. So you'll hear us talk about that throughout this video or throughout all of our trading. But you're looking for combinations of the candlestick and the volume. And a little side note, these work on 1-minute charts, they work on 2-minute charts, they work on 5-minute charts, 15-minute charts. You could even go to dailies and see almost the exact same examples. The only thing that's changing is the types of the participants that are involved. On a 1-minute chart, you're going to have a lot more nuance, a lot more detail. It's a lot more shorter term traders that are pushing price around. And then when you go to those higher time frames, what you're really looking for is more continuation. You're looking for those bigger players to be acting in a very consistent manner. So as you go higher in the time frame of these candles, you should expect the information to be more distinct. But these patterns, these candlestick patterns, work on all time frames. So here's number 3. And you notice we're going from 5 to 1. So number 3 is the hammer and shooting star. We call it reversal snipers, right? What's actually happening? A hammer in a bullish reversal, the market sells off hard, but then buyers step back in aggressively. That's pushing price back up to close near the highs. One pattern that we're looking at is where it comes down, goes lower, and then comes back and closes at the highs. The shooting star is that bearish reversal, right? That candle opens, it rallies really strongly, but then sellers take over. They crush price back down and it closes down near the lows. So it's the inverse of what's happening. Let's talk through the psychology of what's occurred. The hammer at that support area tells you that buyers just defended that level really hard. That flashed down and then the buyers stepped in and got more aggressive. That shooting star at the resistance level, or even just on a breakout of a resistance level, and then the sellers stepped in really aggressively, the sellers just dumped their shares aggressively into that attempt to break out. So how do you trade this? So after a hammer, you buy after that confirmation. So as soon as it takes out the high of that hammer, you can buy there, and you're going to put your stop below the low of the hammer. Same thing happens in that shooting star, just flipped upside down. So you're going to short after that confirmation, after that next candle starts to go below the prior candle. This is a mistake that and then your stop's going to go above the high of that candle. This is a mistake that a lot of traders make, is they see that hammer or they see that shooting star and they don't let price clear the top of that candle for the long or the low of that candle for the short. They don't get that actual confirmation that it's going. It can be a really painful experience to see that, only to watch price go up and get really excited and enter in and then just get smashed with sellers. So you have to let that confirmation happen. Number 2, the morning star. This is the game over bears pattern. What's actually happening is the morning star is a 3-candle reversal pattern that tells you sellers are done and the buyers are starting to take over. So why this works is it actually shows a perfect transition from bearish momentum to bullish momentum. What you want to do is you want to wait and buy after the 3rd candle closes strong. And your stop placement kind of feels a little weird, but it's below the middle candle's low. What has happened is those sellers got really aggressive, and then we had that pause at the lows, and then you see the buyers stepping in and be really aggressive. Where this actually is amazing is right after a breakout. It shows this perfect transition, and what you want to do is wait for that really hard flush, and then that momentary pause where sellers almost feel like, okay, wow, this is really going to go lower. But what's actually just happening is the buyers are starting to step in. And then more buyers step in, causing the shorts to cover. After that 3rd candle closes strong, you can look for that new trend to be established. You can look for that continuation. Again, context is key here. So as much as we knocked indicators early, if you're using indicators to help you look for trend continuation, you can look for this exact pattern. Or if you're using the SMB Scalp Radar, you can look for this on like a second chance scalp, or even better, as the trade is setting up for a fashionably late, right before your entry for a fashionably late, you're going to look for this exact pattern, because you're going to see the fashionably late, you'll be alerted to it, you'll see it touch view up, drop out hard, the buyers are right there, those big players are right there buying the stock, and you'll look for that continuation. And then you're going to get the cross with the 9 EMA crossing back above VWAP right after this pattern actually forms. So it gives you a better check in your favor. The final thing is something that I think is the most explosive setup you can have, which is just a straight up wedge breakout. Wedges occur on all sorts of time frames, and they occur in lots of different ways, and they're the foundation of most, if not almost all, consolidation breakout patterns. There are some variations to it, but most of them have a clear wedge pattern somewhere in there. And what's actually happening there is this wedge pattern forms when price action goes from ranging to compressing. And the difference between ranging and compressing into a consolidation is ranging can last infinitely. Like that can just go on. A stock can range for a really long period of time. But when it begins to compress, you have a pending resolution. When you have that pending resolution, which ultimately forms that wedge pattern, you actually have a consolidation occurring, which is creating a buildup of energy preceding a bigger breakout. So the wedge starts by telling you the momentum is dying. The stock begins ranging. It gives you less to pay attention to. But when that consolidation occurs, when the stock goes from ranging to consolidating, and then you get a breakout that occurs, especially a breakout with increased volume. And a little tip, we look for 50% increase minimum in the volume bars from the bar before the breakout, before the wedge breakout, to the bar after the wedge breakout. If you have a 50% versus a 100% increase in volume, the 100% is much, much better. But at minimum, you want to see at least a 50% increase in the volume done on the wedge breakout when it occurs. So you look at those two candles. That consolidation candle should be low volume, and then look for at least a 50% increase in the volume on that break candle. You want to enter as soon as you see that confirmed breakout. So you want to allow that price to lift higher. And if you're reading the tape, which we teach in Scalp Radar, you can actually identify where that buyer steps up and then steps up higher as the tape's speeding up. That gives you a little bit of a faster entry. But if you're doing it off of a basic thing, just wait for the candle to close. After that breakout confirms with that increase in volume and that clear break, you can put your stop below the lows for a bullish breakout or above the high of the wedge for the bearish breakout. Okay, now that you know the top 5 candlestick patterns, and these are all pretty basic, but we've gone into some really intense nuances here. It's time to put them to work. So here's the secret. Don't just trade a pattern. Trade a really good opportunity. So we talk a lot about how you want to understand the catalyst plus the setup. That creates your opportunity. And then you come into the trade itself. Even within each of the trades that you're talking about, you will find these candlestick patterns. And these candlestick patterns will help you identify a specific entry. Or on the inverse, you can actually use these candlestick patterns, these top 5 candlestick patterns, to identify a very specific exit to your trade. You might just flip them in reverse. For a really strong trend, you might be looking for one of the other 5. So you really want to understand the specifics of the candlestick patterns that we've taught here today. You never want to trade these in isolation. You want to combine them with volume. You want to combine them with other key metrics, maybe trading resistance or support. And then most importantly, you always want to have a stop loss in place. And if you really want to cut your research time in half, your idea generation time in half, you can go check out the SMB Scalp Radar. The tool scans the market for high probability setups so you can act fast and get the best trades. But even by just going to the webinar, you'll be able to get 5 free cheat sheets for specific trades that you can use these patterns, these candlestick patterns, within those trades to identify specific entries and exits. So which of these patterns has worked best for you? You can drop a comment below, and we're really here to help you trade better, faster, and smarter. So go ahead and like, subscribe, so you're never going to miss a beat. And if you really want to start learning more, check out this video.